Bill Ackman expects Trump to privatize Fannie Mae and Freddie Mac. What does this mean for your agency bonds? Hello, member super savers and bond course fans. I hope you're healthy and well. So this question of what happens to our agency bonds if the incoming Trump administration eliminates or privatizes certain agencies. This question came up multiple times in our recent member lives, and we've gotten even more emails about the safety of agency bonds going forward after articles like this one started circulating in the media in the final days of 2024. From Reuters, Bill Ackman expects Trump to privatize Fannie Mae and Freddie Mac. Your concerns are fully understandable, given that so many in our Diamond NestEgg community hold agency bonds in their portfolio, both for the explicit and implicit government backing and the attractive returns they can offer. So as promised, and before some of you start dumping your agency bonds or perhaps picking up some Fannie Mae and or Freddie Mac stock, let's talk about what's actually happening, what the road to privatization could look like under the incoming Trump administration, and what this could mean for your personal investment holdings. To do this, though, we need to first understand a bit more about Fannie Mae and Freddie Mac, including their bankruptcy and the government takeover in 2008. And that's why this is a two-part series, because it's fairly complex. But it's also a fascinating piece about how the government wants to help as many Americans as possible to buy their own home, and how this is not always as straightforward as it seems. Here are the three topics that we'll be covering today in part one of our two-part Trump and Your Agency Bond series. 1. Why are Fannie Mae and Freddie Mac so important to our country? 2. What exactly do Fannie Mae and Freddie Mac do as mortgage wholesalers? And 3. Why did the government take over Fannie Mae and Freddie Mac in 2008? And here's what we'll be covering in part 2 of the series, which should hopefully be coming to you in the next few days, and which I will link below in the first pinned comment when it's ready. Who is pushing for privatizing Fannie Mae and Freddie Mac? Why? And at what price? Plus, what happens next, and what should agency bondholders do now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Why are Fannie Mae and Freddie Mac so important to our country? Owning your home is part of the American dream. It was all my parents could talk about when we first came to this country, and we were so proud when we finally reached that goal some 20 years later. And indeed, since the 1960s, about 2/3 of Americans have owned their own home, with some fluctuations. And our federal government has played an important role when it comes to home ownership in this country. They've implemented a variety of policies supported by all recent administrations from both sides to make it as easy as possible to buy a house, which in real life means to make mortgages as affordable and as available as possible, since very few people have enough cash to buy a home outright. Most will need to borrow some money for it initially. Prospective home buyers in the U.S. can often finance a home for 30 years at a fixed rate that is not that much higher than comparable Treasury bond rates, assuming you have a respectable down payment, debt-to-income ratio, credit score, and so on. And this makes the U.S. special because most other countries will not offer such long-term mortgages for comparably attractive interest rates. Another advantage that U.S. mortgage owners have, which is typically less available in other countries, is that we can usually prepay as much of our mortgage as we want. For example, when rates fall, we can find a cheaper loan and refinance our existing mortgage. Now, this advantageous mortgage landscape for home buyers does not come about by itself. As I mentioned earlier, much of it is dependent on government intervention. So let's talk a bit about what the federal government does here. There are 3 sets of rules and policies in place to help make mortgages accessible and affordable for as many Americans as possible. 1. Direct help with mortgage interest. This policy is the one that many homeowners are probably most familiar with. If certain conditions are met, and up to a maximum limit, the interest on the mortgage can be deducted from your federal taxes, meaning you pay the interest out of your gross earnings before taxes are deducted. This can be a substantial relief depending on your marginal tax rate. 2. Equal housing opportunity. Again, this is something that many of us should be aware of. This logo appears on mortgage providers' websites and brochures. The government has regulations in place to ensure against unfair discrimination. The Community Reinvestment Act, CRA, of 1977 also instructs banks and savings associations to help borrowers, including mortgage borrowers, in all segments of their communities, including low and moderate income neighborhoods. 3. Deep and liquid mortgage markets. The deeper and more liquid the mortgage market is, the more loans can be approved and given out to home buyers. It's like supermarket managers making sure that their supermarket is always well stocked and that they can easily order more items before they run out. We all saw during the pandemic how important it was for supermarkets to not run out of basic items. As homeowners taking out a mortgage, it's not something we think about and that can easily be taken for granted. But what if lenders ran out of mortgages, so to speak? Having deep and liquid mortgage markets means having a properly functioning secondary wholesale mortgage market where lenders can buy and sell their mortgage and basically not run out of mortgages to dole out to new home buyers. And this is where Fannie Mae and Freddie Mac come in. Over time, the government built a complex and somewhat confusing series of specialized financial institutions with the ultimate goal of making the secondary wholesale mortgage market more liquid. Fannie Mae and Freddie Mac are at the center of the secondary market for mortgages. Without them, there would very likely be less home ownership in our country, as well as even more expensive mortgages. So, Fannie Mae, the Federal National Home Loan Association, FNMA, was established back in 1938, during the time of the New Deal and Great Depression. It went public in 1970 on the New York Stock Exchange and can now be traded OTC, over the counter. Fannie Mae securitizes mortgage loans, meaning it packages individual mortgages as a security and sells them on to investors to expand the secondary mortgage market. More on this shortly. As of September 2024, Fannie Mae had $4.3 trillion in total assets, making it the largest company in the U.S. and the 5th largest in the world in terms of assets, even larger than JP Morgan Chase. Drop a comment below. Did you know that? And does it surprise you? Freddie Mac, the Federal Home Loan Mortgage Corporation, FHLMC, was established in 1970 to provide competition to Fannie Mae. It is essentially the same charter or mandate as Fannie Mae to securitize mortgage loans and sell them on to investors to expand the secondary mortgage market. Freddie Mac went public in 1989, also on the New York Stock Exchange, and can now also be traded OTC, over the counter. As of September 2024, Freddie Mac had $3.3 trillion in total assets, making it the 3rd largest company in the U.S. and the 7th largest in the world in terms of assets, just behind JP Morgan Chase. It's not easy to put a number on Fannie Mae and Freddie Mac's direct and indirect market impact, but the National Association of Realtors thinks that they support around 70% of the mortgage market and remain a vital component of the housing finance system. There are other agencies involved in the secondary mortgage market, including Ginnie Mae, the Government National Mortgage Association, GNMA, which only deals with mortgages insured by the Federal Housing Administration, the Veterans Administration, and Farmers Home Administration, as well as the Federal Home Loan Banks, FHLB, 11 U.S. government-sponsored banks that provide liquidity to financial institutions to support housing finance and community investment. Many of you in our Diamond NestEgg community are already familiar with FHLB via their often attractive yielding new issue agency bond offerings, and also for their critical role in lending to and saving Schwab in its latest turnaround. Ginnie Mae and FHLB are smaller than Fannie Mae and Freddie Mac, though. Like I said earlier, Fannie Mae and Freddie Mac are at the center of the secondary mortgage market, at the center of it all, so to speak. And now that we know why Fannie Mae and Freddie Mac are so important to our country and the homes we own, let's move on to the next section of today's video. What exactly do Fannie Mae and Freddie Mac do as mortgage wholesalers? Mortgage wholesalers is the Diamond NestEgg coin term for Fannie Mae and Freddie Mac, because we find that this helps people understand what the two agencies actually do. Mortgage wholesalers essentially support the mortgage supply chain by making sure there is a functioning secondary market for mortgages that in turn encourages primary lenders, the banks we get our mortgages from, to extend as many mortgages as possible at competitive rates and conditions. Here's an overview of how the secondary market for mortgages works. Fannie Mae and Freddie Mac buy mortgages from banks. Then they securitize, or package the mortgages as a bundle and sell the securitized mortgage bundles to investors. Investors usually get a guarantee of full payment, even if the underlying mortgage borrower defaults. Fannie Mae and Freddie Mac charge a fee for the guarantee that is then saved and invested in the good times in a reserve fund that's meant to cover any defaults in the bad times. So these investors here benefit because they indirectly own the mortgages in the mortgage bundle and get the interest payments and principal repayments. Plus, the investors have the Fannie Mae and Freddie Mac guarantee on top in case the homeowners of the underlying mortgage defaults, and banks and future homeowners benefit as well. This setup makes banks more open and willing to extend mortgages to future homeowners, as the banks can usually sell those new mortgages onto Fannie Mae and Freddie Mac. The banks then don't have to wait for the lengthy repayment process and can focus on the next new business opportunity, the next new mortgage to a prospective homebuyer right away. In addition, the banks don't have to worry about the borrowers defaulting, as that risk goes to Fannie Mae and Freddie Mac when they buy the mortgages. And to make sure that Fannie Mae and Freddie Mac only buy mortgages with a reasonable chance of repayment, they have defined a set of conditions a mortgage must meet in order to qualify as a conforming loan suitable for purchase. One of the best known conditions for a conforming loan is the maximum size of generally $806,500 for a one-unit single-family home in the continental U.S. in 2025, with some exceptions. Some expensive metropolitan areas have limits as high as a bit over $1.2 million. Sounds good, right? When the secondary market for mortgages is working well, Fannie Mae and Freddie Mac benefit, investors in these mortgage bundles benefit, and banks and future homeowners benefit. So, what went wrong? Why did the government take over Fannie Mae and Freddie Mac in 2008? Recall from earlier in the video that Fannie Mae and Freddie Mac were initially established as government-owned entities with a public service mandate to help promote home ownership. However, as they proved successful and kept growing, both entities were privatized and listed on the stock exchange, Fannie Mae in 1970 and Freddie Mac in 1989, as I mentioned before. The federal government felt they were not in the business of running large banks and securities houses and wanted to deconsolidate those large balance sheets from their own. And perhaps they may also have hoped that a bit of private competition and entrepreneurship would help avoid a monopoly and stimulate the market, the same reason why Freddie Mac was established in the first place, as a friendly competitor to Fannie Mae. What this meant was that until 2008, Fannie Mae and Freddie Mac were privately owned companies, but known as GSEs, government-sponsored enterprises. Fannie Mae and Freddie Mac had a somewhat complex setup and mandate. Some might have even called it contradictory, in fact. First, private ownership of shares and private sector management, meaning for-profit. Second, a continuing public mandate to help the secondary market for mortgages. And third, continuing government supervision and regulation by special federal agencies, such as the Federal Housing Finance Agency, the Office of Federal Housing Enterprise Oversight, and the U.S. Department of Housing and Urban Development. This went well for a while, and Fannie Mae and Freddie Mac kept growing and made good money. But then, the great financial crisis of 2008 happened, and it turned out that both Fannie Mae and Freddie Mac were very vulnerable to the subprime crisis and ensuing general recession that many of you here will still remember. When the great financial crisis of 2008 hit, many people couldn't pay their mortgages anymore and defaulted on their payments. Remember, Fannie Mae and Freddie Mac had guaranteed these payments when they had sold these mortgages to investors, and the investors understandably now wanted and expected Fannie Mae and Freddie Mac to step in and make sure payments continued. So Fannie Mae and Freddie Mac turned to the reserve fund that they had built in the good times from the fees they'd been charging for this guarantee, and intended to dip into these savings to pay their investors. But it turned out that both Fannie Mae and Freddie Mac had invested a good part of their reserve fund in subprime mortgages. The irony is that those subprime mortgages were non-conforming loans, meaning that Fannie Mae and Freddie Mac could not have bought those subprime mortgages from banks here in the first place. and would not have been able to securitize them and sell them to investors. But because they invested in subprime mortgages via their reserve fund here, their reserve fund was pretty much worthless at the height of the crisis. So Fannie Mae and Freddie Mac found themselves in a perfect storm. Homeowners defaulting on their payments in an economic crisis, and the savings or reserves they had built for exactly such a scenario insufficient to cover those losses and pay their own investors as guaranteed. Long story short, Fannie Mae and Freddie Mac were basically bankrupt. Now, we need to remember that Fannie Mae and Freddie Mac have never had any explicit guarantee by the federal government since privatization, since the date that they went public. In fact, they still don't have one at the time of this taping, and say so outright on their websites and in their prospectuses, as we can see here in these examples from Fannie Mae. The certificates and payments of principal and interest on the certificates are not guaranteed by the U.S. government and do not constitute a debt or obligation of the United States. But because they were GSEs with a public mandate and probably also too big to fail given their importance for the mortgage market, almost everyone had always assumed that the federal government would step up when worse came to worse. And that's exactly what happened. The federal government put together a rescue package of about $190 billion, and technically they gave them the money not as loans, but in preferred stock. Remember the preferred stock part, because this will be very important in part 2 of our 2-part Trump and Your Agency Bond series, when we dive deeper into the current privatization discussion. With this $190 billion rescue package in preferred stock, the federal government basically took over Fannie Mae and Freddie Mac, took them into conservatorship, as it's called legally. They also installed new management and slowly started to turn around Fannie Mae and Freddie Mac. This probably saved both the mortgage market and the wider financial system from complete collapse in 2008. And indeed, the market continued to function, started to dig itself out of the crisis bit by bit, and no holder of a Fannie Mae or Freddie Mac bond or mortgage-backed security lost any money. That said, like in any textbook bailout, while bondholders, creditors, were protected, individual shareholders, owners, are not meant to be bailed out completely, or at all. So the government also took over 79.9% of the common stock, technically via warrants that could be exercised for free. But for whatever reason, they didn't take everything and let the previous shareholders keep 21.1% of the equity. Maybe they let them keep the 21.1% because many of the original shareholders had been small savers who had bought Fannie Mae and Freddie Mac as safe dividend stocks, and the federal government did not want to treat them all too harshly. In any case, after the bailout, the shares of Fannie Mae and Freddie Mac were worth very little, with a price below $1. As a result, the remaining common shares were delisted from the New York Stock Exchange and only traded over the counter, as a weird curiosity for optimists who thought that one day there would be money in them for shareholders, as Bloomberg says it. So that was the eventful background story for Fannie Mae and Freddie Mac, and how they ended up in government ownership or conservatorship. From a bond investor's perspective, though, where we stand now at the current time, more than 16 years after the bailout, is that when you buy bonds from Fannie Mae, Freddie Mac, and most other agencies that we talk about on this channel, there is the understanding of an implicit guarantee by the federal government that you will be paid your interest and repaid your principal on time and in full. You also know now that Fannie Mae and Freddie Mac are critical to the functioning of the U.S. housing and mortgage market. And when they failed once, the federal government did step in and save them. And everything seems to be humming along just fine right now. And no one is really complaining loudly about any dysfunction in the secondary market for mortgages. So, what is all this talk about the incoming administration changing something that appears to be working so well right now? Who is pushing for privatizing Fannie Mae and Freddie Mac? Why and at what price? Plus, what happens next? And what should agency bondholders do now? That, my financial friend, is what we'll be talking about in part 2 of our 2-part Trump and Your Agency Bonds, which, as I mentioned earlier, should hopefully be coming to you in the next few days, and which I will link below in the first pinned comment when it's ready. But drop a comment below. What do you think? Should we privatize Fannie Mae and Freddie Mac? And why or why not? All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to really get up to speed on bond investing and building out your bond portfolio while rates are still quite attractive, then check out this video. Here are our beginner and intermediate bond courses, which we are in the process of updating. Use coupon code BONDS2025 to get an additional 10% off of our popular bond course bundle before the end of January. The 10% coupon code BONDS2025 can also be used to purchase bond beginners or our intermediate level course Bond Masters individually. And as a reminder, our next Bond Beginners Live course session will be on Sunday, January 19th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into this month's 20-year T-bond and 10-year TIPS auctions. And our next YouTube Member Live will be on Sunday, January 26th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into this month's upcoming 2, 5, and 7-year Treasury auctions and all things fixed income. I've also linked the details on our bond courses and YouTube Super Saver membership below this video for your convenience. See you again very soon with more brand new wealth building content for your financial journey.